Hello and welcome to another edition of Market Masters. The Jefferies Second India Forum 2023 is kicking off today. The conference will host a contingent of 73 companies adding up to $1.3 trillion in market capitalization, $400 billion in FII holding, and about 70% of the Nifty weight will be represented. This is spread across diverse sectors. On the sidelines of this conference kicking off, we have Mahesh Nandurkar from Jefferies joining in to take some questions. So Mahesh, it's always a pleasure. Great to have you with us here on the program today. I want to start by asking you what your conversations with foreign institutional investors suggests about the mood and interest towards India at this point in time.
Thank you, Prashant, for having me here. The mood of the foreign investors, around India, from a structural long-term perspective, has always been, very positive. But despite that, over the last couple of years, we've seen the foreigners selling roughly about $30 billion in Indian equities, and that was primarily on account of concerns regarding valuations. Now, the market has moved sideways over the last year and a half or so, and which means that the valuations have got moderated to the extent of earnings growth, which is roughly 20% that we have seen. And that kind of valuation correction means that the market valuation today are close to their averages, although still at a premium, but not as much of a premium as it used to be in the past, over the last 2 years. And also when we make a comparison with the regional benchmarks, even from that perspective, India is not looking that expensive, is close to the historical premium levels. So I think from both these standpoint, the foreign investor mood from the stock market perspective as well has improved because of this valuation moderation. Secondly, with the $30 billion of selling that we've seen, the portfolio positioning on India also appears to be quite light, and as far as I can remember, it is the lightest level of foreign ownership in India, as compared to the benchmark that we've seen over the last 10-12 years. So putting these two things together, and given the fact that the Indian fundamental story is still holding up quite strong, the earnings growth is still expected to be 15 to 20% CAGR over the next 2 years. The GDP growth is somewhere going to be around 5.5 to 6%. The macros in terms of current account deficit has improved. The inflation is looking much more moderate. So there are various factors which are pointing towards an optimism from a near-term perspective as well. So so to answer your question, Prashant, I would say that the foreign investor mood is definitely improved, and that to some extent is reflected in some of the recent FII flow numbers that we've seen over the past few weeks.
Mahesh, so as you say, the premium that India commands is no longer at an extreme as compared to other emerging markets or to its own historical average, but it still is at a slight premium. You also said earnings growth should be between 15 and 20% for many years to come. But are we once again starting to see that slip happening on earnings expectations and final earnings delivery? Because, we saw that at the end of the third quarter, we saw lots of downgrades. This quarter earnings season is also turning out to be a little mixed in terms of what it is doing to full year FY24 estimates. So I just wanted to comment on that a bit.
Yeah, we have seen some earnings revision on the downside. You're right, after the December quarter, and now we are seeing for the March 23 quarter as well. But Prashant, if you take a more nuanced views of where the positive and the negative surprises are coming through, then you will notice that the downward revisions, especially in this quarter, have been driven more by globally oriented sectors like IT services or some of the commodity names, where we have seen some earnings revisions on the downside. But if you look at the domestic oriented names like banks, autos, I would say even consumer staples, industrial, etc., have actually seen a pretty decent trend on expectation versus delivery. And in fact, some of these stocks have seen earnings upgrades rather than downgrades. So I think while we look at the overall Nifty estimates, and we've seen a slight, maybe like a 1% kind of a downward revision for even for FY24, as you rightly mentioned. But I think that's driven more by the outward-facing sectors and stocks. The domestic-facing stocks and sectors are, holding up reasonably well.
One specific sector locally which has been under a fair bit of pressure is consumers, right? Not high in consumption, but middle and lower end of the consumption spectrum. After the recent Karnataka election verdict, you wrote in a note that while your base case for continuity at the center politically does not change for the general elections in 2024, you do expect the government to turn more populist. Could you explain in what way, Mahesh, and what does that do to the consumption universe under your coverage?
Right. So Prashant, as I think you also mentioned, if we broadly categorize consumption in three buckets, the top end, the medium end and the bottom end, the top end of the consumption sectors and stories are looking very strong. I mean, you can look at it from premium end housing, you can look at the airline traffic, you can look at the hospitality sort of sector, and the results that have come out very, very strong. So the top end is doing very well. The middle end is where we are seeing some issues, as you pointed out. One of the reasons for that also is that now that low base factor is now well behind us, and we've been seeing pretty strong numbers for the last 4-5 quarters. That was also partially aided by the low base. That's not the case anymore. So we need to tone down our expectations from that perspective as well, because the numbers that we're seeing today are more from a like-for-like perspective. But notwithstanding that, what we've also seen is the boom that was created last year, and one of the key drivers for that was also the IT services sector, which not only hired a whole bunch of new people. In fact, in our estimate, almost close to 1 million new people were hired in the last 12 months by the IT services sector. And also the huge salary hikes that were being given. I think that thing is clearly now behind, which is obviously putting some pressure to some extent in the middle end of the consumption basket. And that, I think, segment is rolling over, and I think that we are not really at the bottom of that just as yet. The third consumption segment, the bottom of the pyramid, which has been weak over the last couple of years. But now I think we are seeing some signs of improvement there, and a couple of factors driving it. One is that obviously that bottom of the pyramid segment was impacted quite a lot by the pandemic, but the income levels now have gotten restored almost 18 months ago, but the spending patterns haven't got restored yet. Now they're slowly getting restored. So that is one driver. The second is that we believe that we are clearly at the cusp of an investment cycle. The construction activity has picked up very nicely, both on the residential real estate side as well as the infrastructure side as well. And remember, a large pool of labor that is required for this construction activity comes from rural areas, and then they end up sending money back home. So that cycle of rural remittances has started to be put in place once again. And now going to a higher level. So that's the second factor which should help the rural consumption. And the third, you mentioned about the government measures. Yes, we do expect that running up to the national elections in May 24, and there are some state elections as well later in the year, my sense is that you will see the state and the central government taking a slightly more socialist kind of an approach, an approach that will help consumption at the bottom of the pyramid. And we have seen things happening on those lines even prior to the previous elections as well, right? So you'll remember that even before the 2019 elections, we saw a big increase in the MSP for summer crop or for rice. We saw the new scheme of the PM Kisan Yojana, which involved cash transfer to the farmers, that was instituted before the elections. And there have been a few other bottom of the pyramid schemes like the Ujjwala scheme and the rural electrification and so on. So I think that we have enough examples and to go by. I think some of that can get repeated. May not exactly be in the same format, but maybe in a slightly different format. So yeah, so to answer your question, I think all these things do point towards a revival of consumption at the bottom of the pyramid, which should be good news for some of the two-wheeler names and consumer staple names as well.
Okay. So in the model portfolio that you run, Mahesh, is there a lot of consumption? I mean, what's the weight of consumption, both staples, discretionary?
So on the discretionary side, we are limiting ourselves to autos because, as I mentioned, the non-auto discretionary side is facing that slowdown, and I think we still need to wait and watch in that segment. So the way to play the consumption story, according to me, is through the staples segment, and obviously there are some financial companies as well that are leveraged to retail consumption.
I mean, again, broadly, the QSR space perhaps will fall in that category. I think you have a couple of QSR companies presenting. Devyani, I think, is presenting at your conference. Do you like that space as well?
I think the QSR as a space, once again, looks pretty attractive from a medium-term or a long-term perspective as well. But I just feel that maybe that space as a whole will probably still need to kind of go through a period of 1 or 2 quarters where the investor expectations versus the actual delivery get mitigated. So I would rather wait for a couple of quarters before jumping into the QSR space here.
Got that. Again, on the consumer side, the real estate demand is held up remarkably strong, right? I mean, over the last 1.5 years, even as interest rates have gone up sharply. Do you expect that to hold, I mean, this sales levels across real estate companies to hold at current levels into 24 and beyond as well? And what are investment implications then?
Oh, absolutely, Prashant. In fact, this has been our single biggest high conviction idea, and we have been talking about it for last couple of years, pretty much from the bottom. And while our thesis has played out beautifully even in the last 12 months in terms of the physical property market, doing quite well with the pre-sales numbers surprising on the positive side, despite the mortgage rates going up. But the stocks by themselves did not really do that well until recently, and the primary reason for the for the dispersion between the fundamental performance on the ground and the stock performance has been the investor perception that in a rising interest rate environment, the property sector gets impacted, property stocks get impacted, and that perception has played a big role in causing the dispersion or divergence between the fundamental performance and the stock price performance. But things have started changing, over the last couple of months since RBI has paused. And I think we are clearly now in an environment where at best there could be one more hike, but ideally in my base case there should not be any more hike from here on. And while we may not see much of rate cuts in India, but I think the global stage is quite set for rate cuts going forward, and I think clearly the investors will anticipate that. And so first of all, the divergence, the gap that got created between the physical performance and the stock market performance should get bridged. And secondly, there is a lot more upside for the fundamental performance as well. I think we are in a real estate upcycle. Make no mistake about that. We are only in the 3rd year of real estate upcycle, and I think it's a cycle that should ideally unfold over the next at least 3 to 4 years. So I'm quite optimistic about the fundamentals of the sector and the stock performance of the sector as well. And yeah, so in terms of investment implication, I would say that the property developer as a space looks very attractive.
Mahesh, you said we're in the 3rd year of a real estate upcycle, and then you said this should last another 3 to 4 years, or 4 years, and we're in the 3rd year.
Yes. No. Another 3 to 4 years.
Okay. All right. Thanks for that, Mahesh. We'll take a quick commercial break and we'll shine the spotlight on manufacturing, capital goods, that part of the market, and what excites Mahesh in that space. Stay with us.